Well, hello everyone. I'm Kevin Malone, and I'm here with Jason Putman of MAI, who is our portfolio manager on our MAI MLP portfolio. Just as a background, the history of this portfolio, Jason and I got to know each other in 2015 as the price of oil went from 100 to 30. And in January 2016, we started this portfolio. And the idea of the portfolio at that point in time was to focus on dividend growth, on the whole idea that dividend growth forgives a lot of sins. And so at that point in time, in the beginning of January in 2016, you could buy the Alarian index with a 7% yield. You buy this portfolio with a 5% yield. But Jason, over the last 4 years, we've had 13% dividend growth. So why don't you just take us through what happened and where we might be headed from here.
Great, thanks, Kevin. Yeah, obviously a lot has changed over the past few months. We've had oil drop from over 60 at the beginning of the year to about $20 today. And that's something that oil does. It goes through cycles, like you mentioned in 2015 and 16. That's something that we experienced. We had at that time oil go from 100 to about 25. So we're going through a little bit of a different cycle this time because of the demand destruction. We also had kind of the breakdown of OPEC, which has now since kind of got back on the same page. But that was a contributor to the drop in oil as well. So, the entire energy sector has been impacted, including the pipeline companies, which, we view as they don't really have direct commodity exposure, but they've been impacted, because the entire energy sector has kind of sold off. So we think this is an interesting opportunity given, that these businesses are a lot more stable than kind of general energy. And so, we do view the dividends, as a big factor as well.
Okay, can you just talk a little bit about the fact that they're pipelines and how contracts are made and why you'd make that comment about it's not as directly or shouldn't be as directly impacted as perhaps some other businesses in the oil sector?
Yeah, a vast majority of the pipeline's revenue comes from shipping either oil or gas through the pipeline. So they don't have direct commodity exposure except in very limited circumstances. So it's basically a toll road. They get paid if oil gets shipped through the pipeline. And, when oil goes up or down, it doesn't really impact their business, in the near term. So how it does impact their business is that over time, the companies that drill and produce oil will drill less because they're making less money. So right. They're not going to invest as much. And so at some point that does lead to an impact on the pipeline companies, but the severity is much, much different than the general energy market.
Right. So Corona has obviously slowed down the world. And as you mentioned, demand has changed pretty dramatically. The Saudis and the Russians said they were going to, increase oil production when the need for oil looks like it's a lot less. So can you just talk about how you see this playing out and what the numbers look like as it relates to demand today and what we thought demand would be perhaps a month or a quarter ago?
Yes, I mean, that's been the big factor, in terms of the demand decrease. So we've seen, heading into this, demand was about 100 million barrels a day, roughly. Today, we're probably 75, 80 range. So we're off quite a bit. Right. And OPEC has, as of last week, they got back on the same page. So they've cut production by over 10 million barrels a day. But we still have this supply-demand imbalance. And so we're continuing to see inventories build. And I think that's the reason that oil is at $20, is that, inventories continue to build probably in April and May. And then it's going to be dependent on how fast the demand recovery occurs. And so once it starts to occur, prices can start to rise. But the nice thing about the pipeline companies is that I think they're in good financial shape. In order to make money in the energy sector, especially today with prices off a lot, you got to make sure that you make it to the other side. And so I think a lot of the exploration companies that have the direct commodity exposure, I think they run the risk of not making it to the other side. Whereas, is the case, especially with the ones that we hold. I feel pretty comfortable that, they're in a good financial position. They can survive a downturn of 1 to 2 years and still come out the other side in good health.
So some of these companies are trading at kind of absurd prices. I think there's one stock in the portfolio that's trading at 2 times cash flow.
Yeah, no, we didn't see a lot of discrimination in terms of how the market responded. Pretty much all energy, including the majors like ExxonMobil and BP, those big sort of companies, all sold off in this, in this downturn. And normally there is, in previous downturns, pipelines do a little bit better, the majors do a little bit better. In this downturn, while that's been true to some extent, it's kind of been just sell everything. And in a lot of ways, I think that's where the opportunity is that there wasn't a lot of discrimination.
Right.
There's been a lot of forced selling, because of margin, and it gets into a little bit more technical nature of kind of what's happened. But, as far as the pipeline companies go, I think they're in, strong financial shape. We will see companies reduce dividends, I think, more out of conservatism than out of necessity.
Right.
But we have seen a couple companies cut so far, and in each of those cases, the stocks actually outperformed, because I think liquidity is clearly the biggest focus, on investors' minds right now, and again, making sure they make it to the other side. So even if dividends are reduced a little bit to help with that, I think that's a good thing.
Yeah. So I love your expression of getting to the other side, because exactly how we see it. So talk about dividend level. If you looked at the last 4 quarters of dividends on the stocks at the price they are, you'd think you'd have a 20% yield. We're not going to have a 20% yield. What's your expectation of yield on this portfolio as we look out 12 months?
It's a little bit of a difficult question, I think, because it's not necessarily about need. I think all of the companies that we have can continue to pay the dividend for the next year, maybe even year and a half. But with some of it, where the companies are trading, let's say you're trading at a 20% yield, I think management start to wonder, are we getting credit for this? Does it make sense for us to pay them? Maybe we should buy back our stock. Maybe we should reduce debt. So I'd say that there's likely to be more cuts, but also I think we'll be surprised that several companies probably don't end up cutting as well. So it's going to come down to kind of each individual management's team decision. And so that makes it a little bit tricky to answer.
But your expectation is that it will be lower, perhaps considerably lower than it is right now. I think our clients would be thrilled if it was in the order of 6 to 7% yield. You think that's in the cards, or you think the yield might be lower than?
No, I think it'll probably actually be higher than that. But again, what we're focused on is how much cash flow are these companies generating.
Right.
So if we have 15%, let's say, or 20% discretionary cash flow, are we going to choose to pay it all out in a dividend? Or are we going to choose to reduce debt with it? So in this kind of uncertain environment, I think it's important that companies remain flexible and have the ability to, reduce debt or maybe even buy back their stock. We just saw one of the ones that you mentioned that's trading at kind of ridiculous levels. They maintain their dividend, and the dividend it's actually over 40%. Yeah. So they just announced that they're maintaining it. I wasn't sure what they were going to do, and they bought back stock in the quarter even. So, again, it's gonna be a case by case, analysis.
Well, it looks to us like for the investor who's got a time horizon of a few years, that this is a very interesting opportunity. It looks like these stocks, seem to be, the price is very highly correlated to the stock price is highly correlated to the price of oil. But the fundamentals of the company really aren't highly correlated to the price of oil. You see that?
Yeah, it's interesting. One of the original reasons that we got into this sector, just investing in pipelines, was that they had kind of little correlation, from a business standpoint. And historically, if you look back over the long term, the correlation was only about 30%. So it was pretty low. But what we do see is in times of stress. So when prices get either really high or really low, the correlation goes up. And so we're obviously in one of those periods now.
Sure.
And, you know, like I talked about, getting to the other side. So when oil eventually will be higher, it will be $40, $50. I don't know if it might take 2 to 3 years to get there, but when it eventually does recover, you know, these companies we think are strong enough that they'll be there when that happens, and there's a lot of upside in the names should that scenario occur.
And even if we just got back to $45 oil, not $65 oil where it was at the end of the year, these companies would be in really good shape.
Yeah, exactly. So what we're going to see, just like we saw in 2015, you know, when oil went from 100 to 25, we saw a very similar kind of dynamic play out,
right,
where the drilling for new oil and gas really dropped off,
right,
and the production also, it's on a lag, but over the next, you know, in 2016, I think it was in August of 2016, you know, basically over about an 18-month period, oil production in the U.S. dropped about 10, 12%, somewhere in that range.
right.
And I think we'll see a similar kind of decline here. So, you know, oil production is going to start declining, and that is going to have an impact, but it's not, you know, it's not like all of your revenues go away all of a sudden. It's more of a, you know, maybe a 10% impact this year, and maybe a 20% total impact next year as production kind of slows.
Yeah.
And that's why oil prices eventually recover, because supply
right,
will, you know, new investments will drop off, and supply will also drop off, and then
right,
we'll get back into balance, you know, in supply demand.
Sure. Well, Jason, thanks very much. I think this is we think this is a very interesting opportunity for the right type of client who has a long-term view, and we appreciate you managing the portfolio for us. And we'll probably be back again at some point in time as this plays out to do another one of these. So, thanks very much.
Great. Thanks again, Kevin. Appreciate it.